Imagine staring at a trading terminal where, half the screen tells you the global economic system is just completely fracturing. And then the other half tells you we're quietly entering this golden age of digital infrastructure.
Yeah, it's a completely bizarre split-screen reality right now.
It really is. And that's exactly the temporal dissonance we're dissecting in your custom deep dive today. We are looking at the market data from April 3, 2026.
Right.
And on one hand, the spot market is heavily bleeding. It's behaving exactly like a highly sensitive high beta tech proxy right in the face of this severe global friction.
Right, but then simultaneously, the underlying multi-trillion-dollar plumbing of this entire space is securing historic, permanent federal upgrades.
Exactly. So to understand how these two conflicting realities exist at the same time, we really have to separate the immediate, emotional reaction of the markets from the long-term engineering that's being laid down right beneath our feet.
Yeah, it's a profound structural dissonance. I mean, we are watching physical, kinetic world events violently collide with digital asset microstructures.
So let's just start with that immediate panic. Because to understand why capital is draining out of the asset class right now, we have to look at the physical world.
We do.
The Middle Eastern conflict has severely escalated past just diplomatic posturing. We are now seeing the systematic degradation of critical civilian and economic infrastructure.
Yeah, the data from the early hours of April 3rd marks a definitive shift in the conflict's architecture. Iranian asymmetric forces deployed a coordinated drone strike matrix that actually penetrated Allied Gulf airspace.
Wow.
And the immediate target was the Mina al-Ahmadi oil refinery in Kuwait, which ignited severe fires across multiple operational units.
Wait, hold on, though. I mean, we've seen Middle Eastern energy flare-ups for decades, right? And the market usually just, prices in a temporary premium on crude.
Right.
Why is this specific strike sending such a massive structural shockwave through global liquidity?
Because the oil refinery wasn't the only target, and honestly, it wasn't even the most vital one. At dawn, there was a secondary wave of strikes that hit a major power and desalination plant. And that is the crucial escalation.
Wait, really? A desalination plant?
Yeah. Approximately 90% of Kuwait's total drinking water supply is artificially generated through that exact desalination infrastructure.
Oh, wow.
So this is what we call a thermodynamic shock.
Okay, unpack that mechanism for me.
Yeah.
How does a thermodynamic shock in Kuwait actively drain capital from global markets? Like, what's the connection?
Well, think about the energy intensity of artificial water generation. Desalination requires an immense, uninterrupted supply of power.
Right.
So when you physically destroy that capability, you aren't just slowing down exports. You are fundamentally threatening the biological and economic survival of a sovereign state.
Right, because without water, everything just stops.
Exactly. It demonstrates a logistical capability to completely break a nation's foundational water supply. So when regional stability models have to suddenly factor in the total collapse of basic utilities, the risk premium on everything just skyrockets.
Which perfectly explains why we're seeing such an extreme, immediate macroeconomic fallout halfway across the globe.
Yeah.
I mean, you look at South Korea, the 14th largest economy in the world.
Yes.
President Lee Jae-myung is pushing an emergency supplementary budget of 26.2 trillion won. That is 17.3 billion US dollars.
It's a staggering amount of money.
It's crazy. They are literally deploying a massive, quote-unquote, high oil price damage support fund just to subsidize the nation against this crisis.
Yeah.
And they're using excess tax revenues so they don't have to issue inflationary bonds.
And that, right there, is the exact mechanism of global liquidity drain.
Okay, how so?
Well, when a major industrial powerhouse like South Korea is forced to instantaneously deploy nearly $20 billion in fiat just to keep their factories running and the lights on, that is capital that is no longer available for investment.
Right.
It's not available for growth or risk assets. It is capital burned purely for survival.
But, throwing $17 billion at the problem only works if the geopolitical bleeding eventually stops.
Mm-hmm.
And when we look at the diplomatic layer to see if a fix is coming, we see two completely conflicting realities. You have former Iranian Foreign Minister Javad Zarif publishing a comprehensive ceasefire framework in Foreign Affairs magazine.
Yeah.
But simultaneously, the United States Senate is locked in a full-blown constitutional crisis over this exact conflict.
Yeah, the domestic political fracture in the U.S. is actively amplifying the global panic. because European naval forces haven't provided sufficient support in the Strait of Hormuz.
Right.
And because of that, President Trump is threatening to withdraw the United States from NATO entirely.
Which immediately triggers a jurisdictional war in Washington.
Yeah.
I mean, we're seeing senators invoking the 2023 National Defense Authorization Act, which legally mandates a 2/3 Senate vote to actually leave NATO.
Right, the NDAA.
Meanwhile, you have other senators citing Article 2 executive powers, basically arguing the president has the unilateral authority to withdraw.
And that legal ambiguity is exactly what markets despise. I mean, if the U.S. were to actually leave NATO, Europe would have to instantaneously deploy trillions of euros to rebuild their defense industrial bases from scratch.
Wow.
And that level of emergency spending would absolutely debase the euro.
So if you're an algorithm managing hundreds of billions of dollars, how do you mathematically process a crippled Middle Eastern water supply, a $17 billion South Korean emergency fund, and a potential NATO collapse?
You seek ultimate, unassailable safety. In response to all these tail risks, United States Treasury yields and the DXY, the U.S. dollar index, are just spiking violently.
Right.
Institutional algorithms are programmed to look at rising yields and an appreciating dollar and immediately ruthlessly reprice risk. They systematically drain capital out of anything deemed volatile.
So if you're listening to this and checking your portfolio, you're probably wondering why an asset class built entirely on the premise of being a non-sovereign safe haven is bleeding out right when the world actually needs a safe haven.
It feels deeply counterintuitive.
It really does. I mean, we're seeing the asset trade purely as a zero-yield, high-beta tech proxy.
The empirical telemetry is brutal right now. The spot price is structurally vulnerable, compressing near the $66,000 threshold. And technically, there's a massive algorithmic ceiling right around $74,000.
Right. The data highlights that that $74,000 mark aligns perfectly with a 38.2% Fibonacci retracement of the macro downward impulse. But, let's strip away the trading jargon for a second. What does that actually mean for the price action?
It means we have an impenetrable wall of automated selling. Every time the spot price creeps up towards $74,000, automated trading bots look at their historical mathematical models, see that 38.2% threshold, and aggressively hammer the sell button.
They just dump it.
Exactly. They are programmed to view that specific price point as the optimal place to exit a losing position during a macro downtrend.
And the ETF flows the exact vehicles that were supposed to institutionalize this asset and stabilize it. They're actively reinforcing that downward pressure. On April 1st, the ecosystem absorbed a severe $174 million net outflow.
Yeah.
And then April 2nd saw a statistically insignificant $9 million inflow. I mean, even BlackRock's IBIT vehicle, which usually acts like a black hole absorbing capital, is actively bleeding.
Right.
It suffered an $86.5 million outflow on Wednesday and another $3 million outflow on Thursday.
Which brings us to the mathematical trap locking these institutions in. The average U.S. spot ETF holder's cost basis is sitting at approximately $83,408.
Wait, so a massive cohort of institutional capital that deployed into these ETFs is currently severely underwater.
Heavily underwater.
Okay, let's unpack this. We were told institutional adoption meant diamond hands and reduced volatility. The whole pitch was that once fiduciaries arrived, the market would mature.
Right, the adult supervision narrative.
Exactly. But they're the first ones to panic sell the absolute second bond yield to rise. Our traditional finance algorithms just ruthlessly cannibalizing the spot market.
What's fascinating here is the mechanical reality of how physically backed wrappers actually function. It's all about the authorized participants, or APs.
Okay.
When wealth managers see these macro headwinds, the Kuwait strikes, the NATO friction, they decide to liquidate their digital asset ETFs to move into cash or bonds. So they hit the sell button on their brokerage screen.
But because it's a physical ETF, that isn't just a paper trade.
Exactly. When those net redemptions hit the system, they mechanically force the authorized participants to liquidate the underlying asset directly onto the open market to generate the actual cash needed to pay out those wealth managers.
Oh, wow.
So the $174 million outflow wasn't just a change in sentiment. It generated relentless automated ask-side pressure. It actively starved the order books of passive bid-side liquidity.
So the architecture of the ETF itself mathematically guarantees the suppression of the spot valuation when macro flows turn negative. The selling pressure is completely automated.
Precisely. Traditional finance isn't acting with diamond hands because their risk models literally don't allow for it. They are treating this strictly as a risk-on, high-beta trade.
But here's where it gets really interesting and where that split-screen dissonance really takes shape. Because while the spot price is getting hammered by algorithms and macroeconomic panic, the long-term foundational infrastructure of the asset class just achieved a historic regulatory breakthrough.
And the market is completely ignoring it.
Completely.
The geopolitical noise is entirely overshadowing the fact that the jurisdictional perimeter surrounding institutional digital asset custody in the United States has just been permanently altered.
We are talking about Coinbase successfully securing conditional approval from the Office of the Controller of the Currency, the OCC.
Yes.
They're establishing the Coinbase National Trust Company. And up until now, crypto custody has been this highly fragmented, messy, 50-state patchwork of local money transmitter licenses. This elevates it into direct federal oversight.
And the legal firewalls built into the specific charter are paramount. This is classified as a de novo, non-insured national trust bank.
All right.
Crucially, it strictly forbids retail deposits, and it categorically outlaws fractional reserve banking.
Let me push back on that, though, because from a traditional banking perspective, that sounds like a terrible business model.
Yeah.
Why would a massive crypto entity voluntarily lock themselves out of fractional reserve banking?
Well,
I mean, they can't lend out the assets sitting in custody to earn a yield spread like a normal commercial bank does with fiat.
yeah.
Aren't they just leaving money on the table?
They are leaving yield on the table, yes, but they are buying ultimate institutional trust. By being legally prohibited from commingling or lending custodial collateral, the OCC has essentially established an absolute quarantine. It ensures that extreme cryptographic market volatility cannot infect traditional commercial banking balance sheets and vice versa.
So if there is a massive liquidation event in the crypto markets, the bank doesn't collapse because they never lent the assets out in the first place.
Exactly. And this tactical move completely bypasses the stalled Clarity Act. That legislation is currently paralyzed in a Senate recess over highly contested stablecoin yield provisions.
Right.
Plus, there's intense friction from banking lobbyists, specifically the independent community bankers of America who are terrified of deposit flight.
Makes sense.
The industry realized Congress was deadlocked, so they utilized the OCC pathway to secure federal banking infrastructure independently.
And the scale of this upgrade is driven by pure mathematical necessity. I mean, by the close of 2025, Coinbase custody held over $376 billion in assets. That is 13% of the entire global cryptocurrency market capitalization.
Massive.
And furthermore, they manage the custody for over 80% of all digital asset ETFs globally.
Right. And you just cannot secure $1/3 trillion in foundational collateral using a patchwork of local state licenses. It doesn't work.
No.
By securing this national trust charter, they formally satisfy the stringent qualified custodian definitions mandated by the Investment Company Act of 1940.
Which is the exact legal certainty required for the ultra-conservative allocators, right? Like the multi-trillion-dollar state pension funds, university endowments, sovereign wealth vehicles. This makes them finally feel safe allocating capital directly rather than just through ETFs.
Correct. It transforms the asset from a speculative tech proxy into a federally recognized, sovereign-grade custodial asset.
And the foundation hardening doesn't stop at just the custody layer. There is a massive technological leap happening simultaneously with the launch of the Buy 402 Foundation.
Oh, this is huge.
Yeah, this is backed by heavyweights. Stripe, Cloudflare, Coinbase, all partnering with the Linux Foundation. They're actively reviving and activating the dormant HTTP 402 protocol.
The payment-required status code. This is a fundamental reimagining of Internet architecture.
Break that down for us. What does activating a dormant Internet protocol actually do for the digital asset space?
Well, historically, the Internet was built to transfer information, not value. To move money, we had to build clunky third-party payment gateways on top of the web.
Right, like plugging in your credit card details every time.
Exactly. But the HTTP 402 protocol essentially bakes an instant stablecoin settlement layer directly into web interactions. It is specifically designed for autonomous AI machine-to-machine payments.
So we are moving from an internet where you simply read data to an internet where your computer's AI can instantly buy and sell its own data or compute power in real time.
Yes.
And without ever needing a human to approve a credit card transaction. It's essentially HTML for money.
Exactly. It enables AI agents and APIs to execute and settle microtransactions instantly without needing traditional bank accounts.
It's like traditional finance is stuck in a massive traffic jam, honking their horns over interest rates, NATO fractures, and ETF outflows. But entirely beneath them, tech giants just finished building a dedicated high-speed subway system.
That's a great analogy.
Right. The HTTP 402 protocol, where AI machines can zip capital back and forth instantly, completely bypassing the human traffic jam above.
If we connect this to the bigger picture, that is the perfect way to visualize the structural logic of this epoch.
Yeah.
The immediate spot market volatility is erratic because it is driven by human emotion and legacy fiat constraints reacting to geopolitical shocks. But the pipes for massive sovereign capital rotation, as well as the foundational settlement layer for AI native commerce, are officially being laid. That hardening is happening entirely independent of the current spot price.
So, synthesizing all of this for you, the listener, the market is currently trapped in extreme temporal dissonance. On the surface, real-world kinetic shocks like the destruction of Kuwait's desalination infrastructure are restricting fiat liquidity and driving violent institutional distribution.
Right.
The algorithms are suppressing prices and washing out leveraged positions. But fundamentally, underneath all of that noise, sovereign-grade custody and universal internet payment rails are permanently locking into place.
It is the stark divergence between cyclical volatility and secular infrastructure growth. Traditional finance participants may be abandoning the asset at the first sign of macroeconomic trouble today, but the architectural upgrades, the OCC Charter and the BICE 402 protocol, ensure that the capacity to absorb global capital tomorrow is exponentially larger.
Which leaves us with a final provocative thought for you to mull over as you digest the data from this deep dive.
We've established the temporal dissonance between human panic and structural tech upgrades. But, building on that BICE 402 foundation data, if autonomous AI agents begin widely utilizing the HTTP 402 protocol for instant machine-to-machine stablecoin settlement,
Yeah?
how long until the sheer volume of frictionless AI-driven capital flows completely eclipses the erratic, emotion-driven trading of human traditional finance allocators?
It really forces us to question the future velocity of money.
Yeah.
I mean, when machines trade with machines to procure compute power, they don't panic sell because treasury yield spiked or because a diplomatic framework fractured.
No, they don't care about that at all. Exactly. They execute flawlessly based on programmed utility.
Exactly. When the underlying foundation is finally finished, the market might not just look fundamentally different. It might not even be occupied by the same kind of residents.